Imagine walking into a library filled with thousands of books on investing. Most of them talk about balance sheets, ratios, numbers, and formulas. They tell you how to measure profits and how to compare one company with another. But very few of them teach you how to see beyond the numbers. Philip Fisher's Common Stocks and Uncommon Profits is different. It is not just about what you see on paper. It is about understanding the soul of a business. Fisher was one of the first to say that great investments are not only built on mathematics. They are built on people, ideas, research, innovation, and character. He believed that if you truly want uncommon profits, you must search for uncommon qualities in companies. This means asking questions like, is the management trustworthy? Is the company creating products that people will still need 10 or 20 years from now? Does it treat employees, suppliers, and customers with respect? Can it adapt when the world changes? This approach is called growth investing. It focuses not just on where the company is today, but on where it can go tomorrow. That is why Warren Buffett himself once said that he is 50% Benjamin Graham and 50% Philip Fisher. From Graham, he learned the value of discipline and safety. From Fisher, he learned how to look at the future potential of a company. The book is written in simple but powerful language. Each chapter acts like a guidepost for an investor who is willing to think deeper. It starts by showing us how to read the past history of a company. Because to judge the future, we must first understand the patterns of the past. That is where Fisher begins his journey. And that is where we will begin too, with Chapter 1. Chapter 1. Clues from the past. Every company has a story. Just like people, companies carry habits, strengths, and weaknesses that are shaped by their past. Philip Fisher believed that if we want to predict how a company will behave in the future, we must carefully study how it behaved before. History leaves clues. These clues are not always written in bold headlines. They hide in the way management handled problems, the way employees reacted to changes, and the way the company adapted to competition. Think of it like watching a friend. If a friend always shows up late to every meeting, chances are they will also be late tomorrow. If they are reliable and honest in small matters, they will likely be reliable when bigger challenges appear. The same is true for businesses. A company that has shown flexibility and creativity in solving problems before will likely continue doing so in the future. A company that has repeatedly failed to innovate or mismanaged resources will most likely repeat those mistakes. Fisher asked investors to look at patterns instead of one-time events. For example, if a company launched a new product that failed, that alone is not a death sentence. What matters is how management responded. Did they learn from the mistake? Did they improve their process? Did they show the courage to try again? Or did they cover up the failure and continue in the same old way? He also pointed out that numbers alone can mislead. Financial statements can show profits, but they do not always reveal whether those profits are sustainable. Only by examining the company's past decisions can you know if it has the strength to survive future challenges. Imagine two companies making the same profit today. Company A grew because it kept finding new opportunities. Company B grew by taking reckless risks. Without studying their histories, both look the same. But only one has a real chance to create wealth in the long run. Another clue from the past is how the company treated its people. If workers were respected and motivated, the company likely built a culture of loyalty. If employees were constantly leaving or complaining, that is a sign of hidden weakness. This is not always visible in the numbers, but becomes clear when you look at history. Fisher also advised studying how management behaved in times of crisis. Anyone can look strong in good times. The real test comes when markets crash, when products fail, or when new competitors arrive. Did the leaders panic, or did they act with wisdom and calm? Did they use the crisis to strengthen the company, or did they make desperate short-term choices that harmed the future? Such moments reveal the true character of leadership. The past also gives clues about honesty. If management was open about mistakes before, they are more likely to be trusted now. But if they often hid facts or gave excuses, then investors should be cautious. A company may have wonderful numbers, but without honesty and leadership, those numbers can quickly vanish. In short, Chapter 1 teaches us that the past is a mirror. It does not tell us everything, but it shows us enough to make a wise judgment. By studying history, we learn which companies are worth trusting with our money and which ones are not. This lesson naturally leads us to the next idea in Fisher's book. Numbers and history alone are not enough. To truly understand a company, we must also listen to the voices of people around it. The suppliers, the customers, the competitors, even the employees. Fisher called this the method of scuttlebutt, and in the next chapter, he explains why this method is one of the most powerful tools an investor can use. Chapter 2. What Scuttlebutt Can Do. Imagine trying to understand a city by only looking at a map. The map shows streets and distances, but it cannot tell you how the city feels. It does not reveal which restaurants are full of happy customers or which streets are unsafe at night. To truly know the city, you must walk its roads, talk to the locals, and listen to their stories. Philip Fisher believed that investing works the same way. Annual reports and balance sheets are like maps. They are useful, but they cannot show the living reality of a company. To discover that reality, you need what Fisher called scuttlebutt. Scuttlebutt means gathering information from people who have real contact with the company. This includes suppliers who provide raw materials, customers who buy the products, competitors who watch every move, and even employees who see the company's culture from the inside. Each of these people holds a piece of the puzzle. When an investor takes time to collect these pieces, a clear picture of the company begins to form. For example, suppose you are considering investing in a company that manufactures machinery. The financial report may show strong profits, but what if suppliers quietly complain that the company delays payments? Or what if customers whisper that the machines often break down? Or perhaps competitors admit, with frustration, that the company's technology is far ahead of everyone else. These voices tell you truths that numbers alone cannot. Fisher explained that scuttlebutt works best when it is broad and balanced. You cannot rely on just one person's opinion. A supplier may be angry because of one late payment, while the majority are satisfied. That is why the investor must collect many small pieces of information and compare them. When stories from different sources begin to match, the truth becomes visible. This method requires patience and courage. It is much easier to sit at a desk and read reports. But the serious investor, the one who seeks uncommon profits, must step into the real world. He must ask questions, listen carefully, and connect dots that others ignore. Scuttlebutt is not gossip. It is disciplined research, guided by curiosity and respect for facts. There is another benefit to this method. When you talk to people connected with a company, you also begin to sense its culture. Is it a company that inspires pride in its employees? Do customers speak with loyalty and excitement? Do competitors secretly admire it even as they fight it? Culture cannot be measured in numbers, yet it often decides whether a company will keep growing or slowly decline. Fisher believed that scuttlebutt is the closest thing an investor has to a crystal ball. It does not predict the future perfectly, but it shows whether the foundation of the company is strong. When combined with historical study, scuttlebutt gives the investor confidence to act boldly. This chapter naturally opens the door to the next question. Once you have history and scuttlebutt, how do you actually decide which company to buy? What qualities separate an average stock from an extraordinary one? Fisher answered this with his famous list of 15 points, a checklist that every serious investor should know. And that is what we will explore in the next chapter. Chapter 3. What to buy. The 15 points to look for in a common stock. If you were choosing a life partner, you would not decide only by looks or one single conversation. You would consider their values, their character, their future goals, and how they behave under stress. Philip Fisher believed that investing in a company is very similar. To find uncommon profits, you must choose companies with uncommon qualities. To help investors, Fisher created a list of 15 points. These are not quick tricks, but a deep checklist for judging the true quality of a business. Point 1. Does the company have products or services with real growth potential? A good business today is not enough. It must have a future. If demand for its products will rise over the next 10 to 20 years, that is a green signal. Point 2. Does management have the determination to keep developing new products? Even the best product will one day face competition. Companies that keep creating new ideas stay ahead. Point 3. How effective is its research and development? A company that invests wisely in research builds a foundation for future innovation. This is where tomorrow's profits are born. Point 4. Does the company have a strong sales organization? A brilliant product without good salespeople will fail. The ability to market and distribute effectively is essential. Point 5. Are profit margins healthy and improving? Fisher reminded us that growth without profit is meaningless. Margins must not only exist, but show signs of strength over time. Point 6. How does the company treat its workers? If employees are respected and motivated, they become engines of growth. High turnover or unhappy workers are danger signs. Point 7. Does the company have depth of management? A company that depends only on one genius leader is fragile. Strong organizations have capable teams at many levels. Point 8. Are costs kept under control? Some companies grow but waste money. Others grow and stay disciplined. The latter is far more valuable. Point 9. Does management use modern accounting and internal controls? Without proper systems, profits can be an illusion. Good controls create trust. Point 10. Does the company focus on short-term or long-term? A company obsessed with only next quarter's results may miss bigger opportunities. The best leaders balance today's needs with tomorrow's vision. Point 11. Does it have realistic growth plans? Dreaming is not enough. Plans must be practical, supported by resources and clear strategies. Point 12. How honest is management about difficulties? No company is perfect, but great companies admit mistakes and fix them. Weak companies hide problems until it is too late. Point 13. Do leaders speak more than they act? True leaders prove themselves through action. If a company constantly makes promises but rarely delivers, caution is needed. Point 14. How does management treat investors? Do they share information openly? Do they respect shareholders as partners? Transparency is a powerful sign of integrity. Point 15. Is the company driven by genuine integrity? This is the foundation of everything. A company can survive competition, but it cannot survive dishonesty forever. When an investor applies these 15 points, the picture becomes clear. A company that meets most of these conditions is a rare treasure. It may not look cheap today, but its long-term rewards are far greater than average companies bought at low prices. Fisher's checklist is like a compass. It shows the direction toward quality. And once you have found such quality, the next question arises. How many of these rare companies should you hold in your portfolio? Should you spread your money across dozens of stocks or concentrate on a few excellent ones? Fisher answers this in the next chapter, where he challenges the common belief about diversification. Chapter 4. General Portfolio Policy. Why not diversify? Most financial advisors repeat one lesson endlessly. Diversify your investments. Do not put all your eggs in one basket. Spread your money across dozens of companies and industries. At first, this sounds wise. It feels safe. But Philip Fisher asked investors to think carefully. Does safety come from owning many stocks or from owning the right stocks? Fisher's answer was clear. Too much diversification is often a disguise for ignorance. It is what people do when they do not know enough about any one company. So instead of researching deeply, they buy a little of everything and hope the mix will protect them. But hope is not a strategy. True safety, Fisher explained, comes from knowledge and conviction. Imagine a doctor. Would you trust a doctor who says, "I do not know what disease you have, so I will give you 20 medicines and hope one works"? Of course not. You want a doctor who studies carefully, diagnoses accurately, and gives you the right treatment. In the same way, an investor should not buy 20 or 30 average companies. Instead, they should study deeply and select a few outstanding ones. Fisher believed that a well-chosen portfolio might only need 10 or even fewer companies. The key is quality. If you hold a handful of truly great businesses that continue to grow, you already have enough diversification, because each of these businesses itself is spread across different products, markets, and customers. Great companies often diversify within themselves by expanding into new areas. Of course, Fisher did not argue for putting everything into one single stock. That would be reckless. But he believed that owning too many stocks weakens your focus. You cannot possibly understand 30 or 40 businesses in detail. Your attention becomes shallow. And when your attention is shallow, mistakes multiply. He also pointed out that professional fund managers often over-diversify to protect their careers. If they own 50 stocks and one fails, nobody blames them. But if they own only 8 stocks and one fails, questions will be asked. So they spread widely, not for the benefit of investors, but for their own safety. Individual investors, however, are free from this career risk. They can choose the bold but wiser path of concentration and quality. Diversification, Fisher said, should be like seasoning in food. Too little, and the dish feels empty. Too much, and the true flavor is lost. A balance is needed, but the balance is tilted toward focus, not scattering. Once an investor understands this, another challenge arises. If we are going to concentrate our money in only a few companies, we must be very careful about which ones we choose. And the world is changing. The industries of the future may not be the industries of the past. How do we identify these new dimensions of investing? That is the next step in Fisher's journey. And in the following chapter, he shows how investors should look beyond the present and prepare for the future. Chapter 5. The New Dimensions of Investing. The world of business never stands still. What looked like a safe industry yesterday may become outdated tomorrow. Philip Fisher urged investors to see beyond the present and look toward the future. This is what he called the new dimensions of investing. In earlier times, investors often looked backward. They asked, which companies made profits last year? Which industries have been stable for decades? But Fisher warned that this backward-looking approach was dangerous in a rapidly changing world. Technology, science, and human needs were evolving at great speed. Investors who refused to adjust would be left behind. Think of industries that once seemed unstoppable: railroads, typewriters, and even some traditional banks. For decades, they looked permanent. But innovation reshaped the world and left many old leaders struggling. At the same time, new industries rose, offering fortunes to those who recognized them early. Fisher taught that uncommon profits come not from holding on to the past, but from recognizing the seeds of the future. How can an investor do this? The first step is curiosity. An investor must develop a habit of asking questions about change. What new products are being created? What scientific research could transform daily life? Which companies are investing heavily in innovation? These questions open the mind to possibilities that numbers alone cannot show. Fisher gave special importance to companies that treated research and development not as an expense, but as an investment. He admired businesses that constantly explored new products and new markets. Such companies often create not just one wave of growth, but many waves, decade after decade. But Fisher also warned against blind excitement. Not every new idea is worth money. Many industries promise revolutions, but fail to deliver profits. That is why Scuttlebutt and the 15 points remain vital. They help separate dreams from realities. The investor must ask, does the company have the talent and discipline to turn research into real products? Do customers actually want what the company is building? Is there a clear path to long-term profitability? One more dimension Fisher highlighted was global thinking. Even in his time, he saw that companies were no longer limited to local markets. The future belonged to businesses that could expand across borders, adapt to new cultures, and serve international customers. This, too, was a new dimension that gave an edge to visionary investors. For Fisher, the future was not something to fear, but something to prepare for. The investor who sees beyond today's numbers and recognizes tomorrow's potential is the one who finds uncommon profits. And this leads directly to a practical question. If we identify such promising companies in new dimensions, when should we actually buy their shares? Should we wait for the perfect price, or should we act once we are convinced? This is the challenge Fisher takes up in the next chapter, where he explains the art of timing your purchase. Chapter 6: When to Buy. Timing is one of the greatest puzzles in investing. Many people believe that buying at the lowest price is the mark of genius. Others think it is impossible to know when the right moment comes. Philip Fisher provides a balanced and realistic view. He explains that the perfect time to buy is not about chasing the lowest possible price. It is about identifying the right company and being patient until the market offers a fair opportunity. A great business, even when purchased slightly above the bottom price, will still reward the investor over the long run. The real mistake is waiting too long and missing the chance to own a company with extraordinary growth. Fisher says investors must be willing to act boldly once they have done the homework. If the research confirms that a company has outstanding prospects and meets the standards of quality, then waiting for a temporary dip may cost more than it saves. The market does not always grant a clear discount. Sometimes the price of a stock may keep rising steadily, and the one who hesitates will watch opportunities slip away. However, he does not dismiss caution. Fisher advises that investors should avoid buying during periods of wild optimism, when every headline praises the market. In such times, prices often climb far beyond the real value of businesses. Entering at these peaks can lead to disappointment when reality brings prices back to earth. Instead, he encourages looking for windows when the general mood is uncertain or negative. Periods of fear often open doors to hidden bargains. Fisher highlights that investors must learn to separate noise from reality. News, rumors, and emotional waves constantly push prices up and down. But the underlying business changes at a slower and steadier pace. The wise investor watches the company more than the ticker tape. The right moment to buy comes when the business is strong, the future is promising, and the price is not exaggerated by temporary excitement. Another important point Fisher stresses is gradual accumulation. Instead of buying all shares at once, it can be better to enter in steps. This way, if the market dips, the investor gains a lower average price. If the market rises, at least a portion of the shares are already secured. Patience and planning create balance between caution and decisiveness. He also points out that timing must never replace deep research. A company that does not meet the 15 points or shows weaknesses in management, research, or growth potential will never become a good investment, no matter when it is purchased. Buying the wrong company cheaply is worse than buying the right company fairly. To conclude, Fisher reminds us that the stock market always tempts us with quick moves. But true success comes from aligning the purchase with the quality of the company, not the mood of the crowd. The correct timing is the moment when your knowledge and conviction tell you the company is worth owning for years ahead. That is when an investor must act. This idea flows naturally into the next question. Once an investor has bought, the real challenge begins. Holding a stock is not the end of the journey. At some point, the decision to sell will come. But when is that point? And how can one manage taxes, emotions, and long-term goals at the same time? Fisher takes us into this crucial discussion in the next chapter. Chapter 7: When to Sell and Still Keep the Taxman at Bay. Buying a stock is only half of the journey. The other half, often even harder, is deciding when to sell. Many investors fall into traps at this stage. Some sell too soon out of fear. Others hold too long out of greed. Philip Fisher offers clear guidance to bring discipline and wisdom to this delicate decision. He begins with the first principle. If the reason for buying the stock is still true, then do not sell. If a company continues to show strength in leadership, growth, innovation, and meets the standards of quality, then time is on the investor's side. The longer the holding period, the more compounding multiplies the wealth. Patience becomes the secret weapon. Fisher warns against the temptation of quick profits. Many investors feel excited when a stock rises sharply and they rush to sell for a short gain. But by doing so, they may sacrifice the enormous growth that happens over years. He points out that selling a truly great company too soon is one of the costliest mistakes an investor can make. There are, however, clear conditions when selling is necessary. The first is when the original judgment was wrong. If research later reveals flaws in management, weak prospects, or dishonest practices, the investor must act quickly. Holding a mistake out of pride or hope only increases the damage. The second condition is when the company's fundamentals have changed. For example, a business that once led in innovation may stop investing in research. Or a strong brand may lose its edge in the market. If the qualities that made it a great company fade, then selling becomes the wise choice. The third condition is when another opportunity of higher quality appears, but resources are limited. Fisher advises not to diversify endlessly. If holding a weaker stock prevents owning a stronger one, then it is reasonable to sell and upgrade. He also brings attention to taxes. In many countries, selling a stock means paying a tax on the profit. Frequent trading can turn into a costly leak, reducing overall returns. Fisher suggests that investors think in decades, not days. By holding great companies for long periods, investors not only enjoy compounding, but also keep tax payments minimal. Delaying tax payments is like giving your money more years to grow before the government takes its share. Fisher strongly opposes selling just because the market looks uncertain. Fear of recessions, elections, or wars often drives people to cash out. But history shows that markets recover, and strong companies adapt. Investors who panic miss the rebound and weaken their long-term results. He emphasizes that selling should be guided by facts, not emotions. Greed, fear, rumors, and impatience are dangerous advisors. Rational thinking and honest self-evaluation are the tools to make the right choice. Finally, Fisher reminds us that the best returns often come not from trading in and out, but from staying with outstanding companies for as long as they remain outstanding. Selling is rare, and when it happens, it must be done for solid reasons. This brings us to another hot topic in investing. If holding is so important, what role do dividends play? Should investors focus on cash payouts, or should they rely on growth within the company? Fisher addresses the debate in the next chapter, cutting through the noise surrounding dividends and showing how to think about them wisely. Chapter 8. The Hullabaloo About Dividends. Few topics in investing spark as much debate as dividends. Some investors swear by them, believing steady cash payouts are the only true sign of a healthy company. Others dismiss them, preferring growth and reinvestment. Philip Fisher approaches this argument with careful thought and clears the confusion for long-term investors. He begins by explaining why dividends are attractive. They provide immediate income. They feel certain and concrete. For many, especially retirees, a regular cash flow from stocks offers security. It seems safer than waiting for capital gains that may or may not appear. This emotional comfort is a powerful reason behind the love for dividends. But Fisher urges investors to look deeper. A company that pays out high dividends may be limiting its own future. Every dollar given to shareholders is a dollar not used for research, expansion, or innovation. If the business has strong opportunities for growth, reinvesting profits can multiply value far more than distributing them. In such cases, investors gain greater wealth by allowing the company to compound earnings internally. He points out that many of the greatest growth companies in history started by paying little or no dividends. Instead, they used their profits to build new products, enter new markets, and strengthen their competitive position. Patient shareholders who stayed with them saw their stock value rise many times over. The growth far outweighed what a dividend could have delivered in the short run. That does not mean dividends are always bad. Fisher accepts that once a company matures and no longer has enough opportunities to reinvest at high returns, paying dividends makes sense. At that stage, holding on to profits does not create much additional value. Returning money to shareholders is fair and practical. The key is context. Dividends are wise only when growth options are limited. Fisher also warns against chasing companies just because they promise high dividends. Often, such companies use dividends as bait to cover deeper weaknesses. A business with poor prospects may keep paying high dividends to maintain investor loyalty. But this strategy cannot last forever. Eventually, the lack of reinvestment shows, and the company declines. Taxes again play a role in this discussion. Dividend income is usually taxed immediately, while capital gains can be deferred until a stock is sold. This means that from a tax perspective, growth without dividends often benefits long-term investors more. By delaying taxes, investors let their money stay invested and compounding for years. Another mistake Fisher highlights is assuming that dividends protect against losses. Investors sometimes feel that even if the stock price falls, the dividend is a cushion. But if the underlying business weakens, no dividend can protect the long-term value. The focus must always remain on the company's quality, not on the comfort of a temporary payout. Fisher concludes that dividends should not be the main factor in selecting a stock. The real wealth is created through owning outstanding companies that can grow for decades. Dividends may come eventually, but they are a secondary consideration. The wise investor asks first whether the company can reinvest profitably. If the answer is yes, then dividends can wait. With dividends clarified, Fisher turns to another important subject. Just as there are things investors should do, there are also things they must avoid at all costs. To protect themselves from costly errors, Fisher lays out a list of clear warnings in the next chapter. Chapter 9. 5 Don'ts for Investors. So far, Philip Fisher has shown us what investors should do, but wisdom also lies in knowing what not to do. Many fortunes are lost not because people lack knowledge, but because they fall into common traps. To protect investors, Fisher outlines 5 clear warnings. The don'ts that every serious investor must keep in mind. The first don't. Do not buy a stock only because you like the product. Many people fall in love with companies that make things they personally enjoy. Perhaps it is a favorite drink, gadget, or service. But a popular product does not always equal a profitable business. Competition, costs, management decisions, and industry challenges matter far more. An investor must judge the company as a whole, not just the appeal of its goods. The second don't. Do not ignore the future for the sake of the past. A company may have been successful for decades, but past glory does not guarantee future strength. Industries change. New technology, shifting consumer habits, and global forces can disrupt even the strongest business. Investors who blindly trust history often wake up to unpleasant surprises. The wise approach is to ask how well the company is preparing for tomorrow. The third don't. Do not buy because everyone else is buying. The crowd is often wrong. Market fads create waves of excitement, pushing up prices far beyond reason. Many investors join late, thinking they are safe because others are doing the same. But when the bubble bursts, they face heavy losses. Fisher reminds us that true success comes from independent thinking and careful analysis, not from following the herd. The fourth don't. Do not quibble over small price differences. Many investors waste time waiting for a stock to drop by a tiny fraction before buying. In the long run, these small changes mean little compared to the wealth created by owning a great company. Missing out on years of growth for the sake of a small discount is a costly mistake. The focus should be on quality, not on squeezing the last cent out of timing. The fifth don't. Do not overstretch by diversifying too much. Some investors scatter their money across dozens of stocks, believing this will make them safe. But excessive diversification often spreads attention too thin. Instead of truly understanding a few companies deeply, investors end up knowing little about many. Fisher believes that real safety comes from owning a handful of outstanding companies, studied thoroughly, and chosen with care. Together, these 5 don'ts create a protective shield. They keep investors from wasting energy on shallow judgments, emotional impulses, or herd behavior. By avoiding these traps, one keeps the path clear for disciplined, intelligent investing. Fisher's message is simple but powerful. Success in investing is not just about what you do right. It is equally about avoiding what you do wrong. Just one serious mistake can erase years of progress. By respecting these warnings, investors build a foundation of caution to balance their pursuit of growth. This naturally leads us to another cornerstone of investment philosophy. Avoiding mistakes is good, but how do we prepare for the unknown? How do we guard against risks that cannot be predicted? Fisher explores this through the famous idea of margin of safety in the next chapter. Chapter 10. The concept of margin of safety. In investing, certainty does not exist. No matter how skilled or informed an investor may be, the future always carries risk. This is why the idea of margin of safety has become one of the most respected principles in finance. While Benjamin Graham is often credited with shaping this concept, Philip Fisher interprets it through his own lens, adapting it to his growth-oriented philosophy. The margin of safety is like a cushion. It protects investors from the unknown. Even the best research cannot predict sudden changes such as economic recessions, new competitors, or shifts in consumer behavior. By demanding a margin of safety, the investor ensures that mistakes or surprises will not destroy the investment. Fisher explains that for those who focus on undervalued stocks, margin of safety usually means buying at a price far below the company's actual worth. This way, if the analysis is slightly wrong, the investor still has protection. But Fisher adds a new dimension. For growth investors, margin of safety is not just about cheap prices. It is about the quality of the business itself. A company with strong leadership, continuous innovation, loyal customers, and resilience in changing markets provides a margin of safety through its excellence. Such companies can survive storms better than weaker ones. Even if purchased at a fair price rather than a bargain, their strength provides long-term protection. In other words, safety comes not only from numbers, but from character. Fisher also points out that the biggest danger in investing is permanent loss, not temporary price swings. Stock prices may fall in the short term, but if the business remains solid, they eventually recover. The true margin of safety is the confidence that the company will endure and grow through time. This requires focusing less on daily volatility and more on structural strength. Another layer of margin comes from diversification, though Fisher reminds us not to overdo it. Owning a few outstanding companies in different industries can reduce the risk that one bad event will wipe out the portfolio. But again, the heart of safety is knowledge. Understanding what you own gives far more protection than blindly spreading money around. Fisher also warns against false comfort. Some investors believe that buying cheap or chasing high dividends automatically provides safety. But low prices can signal deep problems, and dividends cannot protect a weak company. True safety must be built on careful judgment of fundamentals, not illusions. The concept of margin of safety is also linked to temperament. Investors must be honest about their limits. If a person is easily shaken by market noise, then even a good stock may feel unsafe to them. Emotional discipline, patience, and the ability to think long-term form part of this invisible margin. Fisher's conclusion is clear. Safety does not come from hiding from risk, but from preparing for it. By focusing on strong companies, studied carefully and chosen wisely, investors build a natural cushion. The margin of safety is not a wall that blocks risk completely. It is a bridge that allows the investor to cross uncertain times without falling. This discussion sets the stage for the next theme. If margin of safety protects us, then how can a conservative investor, someone who seeks peace of mind above all, sleep well at night? Fisher answers this question in the following chapter. Chapter 11. Conservative investors sleep well. Every investor dreams not only of building wealth, but also of peace of mind. What is the use of riches if nights are sleepless, filled with fear about tomorrow's market swings? Philip Fisher addresses this timeless concern by showing how a conservative investor can achieve both safety and growth. At first glance, the phrase conservative investor may sound like someone who avoids risk entirely. But Fisher clarifies that true conservatism is not about hiding from opportunities. It is about taking calculated risks in a way that ensures stability over the long run. A conservative investor is not timid but thoughtful. Fisher explains that the safest path is not buying government bonds or piling money in savings accounts. While these feel secure, they often fail to keep pace with inflation. Over time, the so-called safety of fixed income can quietly erode purchasing power. The real conservative approach is to own outstanding companies that grow steadily and protect wealth from the silent tax of inflation. He emphasizes that conservative investing does not mean chasing the lowest risk on paper. It means choosing businesses with durable strengths. These include excellent management, a culture of innovation, financial discipline, and products that people will need far into the future. Such companies may experience short-term fluctuations, but their long-term trajectory is upward. For the patient investor, they bring both comfort and returns. Fisher also points out that true peace of mind comes from knowledge. When an investor understands exactly why a company is strong, sleepless nights vanish. Fear is often the child of ignorance. By doing deep research and knowing the facts, the investor replaces worry with confidence. Another lesson Fisher shares is the importance of avoiding speculation. Quick profits may look tempting, but they invite restless anxiety. The conservative investor avoids gambling on rumors, tips, or sudden trends. Instead, they build a portfolio slowly and carefully, based on evidence rather than excitement. Taxes also play a role in sleeping well. Frequent trading not only creates stress, but also adds unnecessary tax burdens. A conservative investor benefits by holding quality stocks for long stretches, letting compounding do the work quietly in the background. Fisher reminds readers that being conservative does not mean avoiding growth. In fact, he argues the opposite. True safety comes from companies that grow, adapt, and stay relevant. A stagnant business may feel safe in the present, but in the long term, it risks decline. Growth is the shield that protects wealth across generations. Perhaps the most important part of conservative investing is mindset. A calm, disciplined temperament is as valuable as financial knowledge. When markets fall and others panic, the conservative investor holds steady, guided by research and conviction. By avoiding emotional swings, they protect both their wealth and their peace. In summary, Fisher teaches that conservative investors sleep well because they trust the strength of what they own. They know that wealth built on careful study, patience, and outstanding companies does not vanish with passing storms. It is this blend of wisdom and discipline that creates both financial success and restful nights. From here, Fisher shifts to the role of the professional analyst. If individual investors can gain so much from discipline and research, what should be expected from those who analyze securities for a living? The next chapter dives into the proper mindset of the security analyst. Chapter 12. The proper mindset of the security analyst. Philip Fisher ends his book with a focus on those who dedicate their lives to studying companies and advising others, the security analysts. While their role may seem highly technical, Fisher reminds us that mindset is more important than tools or formulas. The way an analyst thinks can determine whether their advice creates wealth or leads investors astray. The first quality Fisher emphasizes is independence of thought. Analysts must resist the pressure of group opinion. In large financial institutions, it is easy to get trapped in the comfort of consensus. But following the herd rarely leads to outstanding results. The best analysts are willing to hold unpopular views if their research supports them. Independent thinking is the foundation of real insight. Second, Fisher insists on intellectual honesty. An analyst must be willing to admit when an earlier judgment was wrong. Pride and stubbornness are dangerous enemies in finance. Markets constantly change, and clinging to old conclusions can be costly. True professionalism means updating opinions when new facts demand it. Third, the analyst must balance detail with vision. Some analysts bury themselves in endless numbers and reports, losing sight of the big picture. Others stay too vague, relying on broad trends without depth. The proper mindset lies in combining both, mastering details but always linking them to the future direction of the business. Fisher also highlights the danger of overconfidence. Analysts often feel pressured to provide precise forecasts, as if they can predict every twist of the market. But in reality, certainty is an illusion. A wise analyst avoids the trap of pretending to know everything. Instead, they focus on what truly matters: the strengths of management, the capacity for innovation, the resilience of the company, and the long-term opportunities. Another part of the right mindset is humility toward the unknown. Fisher reminds us that no system or method can remove uncertainty. Economic cycles, global politics, or new inventions can reshape industries overnight. Analysts who respect uncertainty prepare better, while those who ignore it set themselves up for failure. He also stresses that analysts should not confuse activity with progress. Producing endless reports, charts, or forecasts may look impressive, but what matters is whether their insights help investors make better decisions. The analyst's role is not to sound clever, but to serve truthfully. Fisher further notes that analysts must protect themselves from conflicts of interest. In many cases, they may feel pressure to please clients, employers, or even the companies they study. But if loyalty to truth is lost, the value of their work disappears. Integrity is the core of their responsibility. Finally, Fisher ties this lesson back to the individual investor. In a sense, every investor must also act as their own security analyst. Each person must develop independent thinking, intellectual honesty, balance, and humility. By adopting this mindset, investors can protect themselves from costly errors and discover opportunities others overlook. With this chapter, Fisher completes his journey. From understanding companies, timing purchases, knowing when to sell, handling dividends, avoiding mistakes, and building safety, he has given readers a full philosophy of intelligent growth investing. His final message is simple but powerful. Wealth is not built on shortcuts or secrets. It is built on clarity of thought, discipline, and the courage to think independently. Thank you for listening to this summary. If you found value in this work and would like to support more content like this, I warmly invite you to subscribe. Your support encourages the sharing of more ideas, more wisdom, and more journeys into the world of books that can change lives.